The objective of the Nedgroup Investments Flexible Income Fund is to deliver a return of at least 10% above the STEFI index. So we're trying to generate a cash plus return for our clients, but we want to do that while minimizing downside risk. So we don't want to put our clients' capital at risk. And we do that by ensuring that we have the highest degree of credit quality. We make sure that we run a diversified portfolio with a good spread of different asset classes. We're not putting all our eggs in one basket. And what we want to do is avoid expensive asset classes which have significant downside risk. The ABAC's fixed income philosophy can be summed up in 2 words: diversified alpha. That entails us using the broadest possible range of fixed income assets and strategies to generate returns. This has 2 benefits. Firstly, we have a wide opportunity set where we can get alpha from many different asset classes and strategies. That enables us to achieve high returns, but it also has an important benefit in terms of diversifying the sources of our return and minimizing our downside risk. The current yield of the fund is around 8.8% at the moment. We think that's quite an attractive yield given the high credit quality of the fund, where we're investing purely in investment grade assets with no exposures below single A rated assets. Some of the instruments include an ABSA basket note, which is a note issued by ABSA, one of the big 4 banks in South Africa, with an underlying credit exposure to a range of high-quality credits in SA. So you've got your top corporates like your Bidvests, your Steinhoffs, your big property companies, the big 4 banks. So a very high-quality, diversified pool of assets issued by ABSA and yielding us above 10%. We've also got credit-linked notes issued by Old Mutual, Naspers, MTN, all high-quality companies, but yielding the portfolio above 10%, which is very attractive in this environment. The duration of the fund is currently 0.2 years, which is 73 days, so less than even a 90-day money market fund. That is a very conservative positioning for the fund at the moment. It's a very low-risk position, and the reason for that is that we don't want the fund to take on interest rate exposure at this point in the cycle with rates at very low levels. So we currently have the majority of our preference share exposure to the big 4 banks, and the reason for this is, firstly, the yield is very attractive. It's currently 8 to 8.5% post-tax, which is a very attractive yield for us to be able to give investors. The second reason is that the pref shares issued by the big 4 banks is quite safe. There's no risk of capital loss or write-down. If the bank does encounter any difficulty, the worst case scenario is that you can skip a dividend, but there's no risk that the asset can be written down. The third benefit is that under new Basel III regulations, there will be a need for the banks to repurchase or restructure these preference shares at some point in the future, and they're currently trading at a 20% discount to par. So there's very attractive potential upside in the future. Over the last few years, rates have moved up from 5% to 7%, and the Reserve Bank recently signaled that we could be at the end of the hiking cycle. The question is whether we now see some cuts going forward. Now, what Lesetja Kganyago has repeatedly said is that the bar for cuts is very high. Yes, we are likely to see a cyclical downturn in inflation, but our view is that inflation is still closer to the upper end of the target band. Structural inflation in SA is closer to the upper end of the target band than the middle. And therefore, the potential for significant rate cuts is quite limited in this environment. You also have a very uncertain political environment, which means that a more conservative approach is warranted in terms of rates in South Africa. The foreign currency debt from S&P was recently downgraded to sub-investment grade. However, our local currency debt remains just above investment grade. However, over the medium term, we believe it's inevitable that our local currency debt will be downgraded to sub-investment grade because of the trajectory of our debt metrics. We've seen a massive increase in debt to GDP levels over the last 7 years, and that is going to continue, especially with the changes that are happening within the finance ministry. Now, given that inevitability, there is a risk that South Africa, when the local currency debt gets moved to sub-investment grade, there is a risk that we are removed from certain global bond indices, primarily the Citi Wigby index. And given if we are out of that index, you'll find investors selling our bonds and in order to account for the fact that we're no longer part of the index. Now, how much is likely to be sold under that? Estimates vary, but it's in the region of 10 to $15 billion. Close to 200 billion rand, which is a very significant amount in the context of the SA bond market. We see currency as a separate asset class. When we invest offshore, it's based on the opportunities that are available in the offshore bond market. So we invest in certain companies domestically who also issue offshore bonds. So the SA government does, Eskom, Transnet, corporates like Steinhoff, Old Mutual, all issue bonds domestically and offshore. And when we see a significant yield gap in the offshore bond space compared to local, that's when we want to invest offshore. Now, once we purchase offshore assets, that adds a currency exposure, but our base case is to actually hedge that back. So the amount of currency exposure we have in the fund is a separate decision which is driven by the valuation of the currency, whether we see the currency, the rand, as cheap or expensive. When we see the rand as very cheap, we want to have a lot of hedges in place. We want to minimize the currency exposure, regardless of what bonds we hold offshore. When the rand is relatively expensive, when we think there's a potential for depreciation, that's when we want to have a higher level of currency exposure. So a great example of that was last year, when on the back of local politics, EM risk, we saw huge opportunities in the offshore bond market where we purchased Eskom bonds, Steinhoff, Old Mutual, Naspers at very attractive yields. But at that point in time, the rand was very undervalued. You had the rand trading above 16, even 17 to the dollar, and we saw that as very cheap with a potential for recovery, which means as we bought those offshore bonds, we didn't want to expose the fund to significant currency risk. So at the early last year, we implemented hedges where we fully hedged back the offshore bonds, and the effective currency exposure was close to zero on the fund. At the moment, we believe that the rand is close to fair value, but we see significant fundamental risk in terms of our metrics relative to the rest of the world, our growth, our fiscal deficit, our current account deficit. On these metrics, we are relatively poor compared to the rest of the world, and given these risks, we believe that the rand should trade somewhat cheap to compensate for that. Because the rand is not trading relatively cheap, we therefore think the risk is towards some depreciation over the course of the year. In terms of our property exposure, we have switched our allocation from SA property to UK property. The reason for that is SA property is relatively expensive at the moment and the fundamentals are quite poor. You've had very little growth in South Africa for the last few years, and that's now beginning to impact the fundamentals of local property. It started off in the corporate sector with office rentals going backwards, but now it's even being impacted. It's now beginning to impact the retail sector. So high quality retail centers, which used to deliver 6-7% trading growth for the last 5 years, you're now finding that going down to 2 or 3%. So the fundamentals in domestic property are deteriorating on the back of the poor economy. On the other hand, we see a lot of value in UK property post-Brexit. So post-Brexit, you had a significant fall in property values, but also a significant depreciation in the pound. Now, the combination of those two has meant that UK property stocks are extremely cheap, trading at very steep discounts to their net asset value, and are pricing in a very negative economic scenario in terms of Brexit. And if you look at the evidence in terms of the British economy, that nightmare scenario of Brexit is not materializing. In fact, the economy is reasonably sound and growth is continuing as normal. So we see a lot of upside potential from a yield perspective, but also as the capital values recover on UK property. Our current foreign bond exposure is 12%. There we take advantage of SA-related names which issue into the offshore market and can often provide us a nice yield pickup relative to buying it domestically. We had a much higher exposure last year when a lot of opportunities opened up due to emerging market sell-offs and SA political risk. And we bought, for example, an Eskom bond at 8 and 9% in dollars. With that yield having compressed to around 4%, we have begun to take some profit and trim that offshore bond exposure. But if we do see another risk-off event, either South Africa-driven, maybe driven by the Fed hiking rates or some sort of EM sell-off, we will be back to increase that exposure again. So the portfolio changes we've made recently is to de-risk the fund. So where assets which we bought at very attractive yields, where the yield spreads have come down, we've begun to trim them and take a bit of profit. We have allowed the cash levels to increase, given that valuations are not as attractive as they were. And on the whole, we've moved to a relatively lower risk position compared to where we were a year ago. But that is in line with our strategy. Our strategy is not to run a constant level of risk, but rather look at what return opportunities, what yield spreads we are getting, and then structure the fund with a risk level to take advantage of that. At times we can run a relatively high risk, but at the moment with yield spreads diminished, where you're not getting compensated for risk, we're happy to run a low risk position. The investment opportunities that we see at the moment are, for example, in UK property, where we're getting attractive yields and assets trading at steep discounts to net asset value. We also work very hard to generate yield opportunities in the local market, even when it's quite a difficult environment. So we spend a lot of time negotiating with banks, negotiating corporates to get assets with attractive yields, although it is more difficult than maybe a year ago. And then the other opportunity is to allow the currency exposure to increase on the fund. So we had a zero currency exposure when the rand was very cheap. Now that we view the rand as somewhat expensive with the potential for depreciation, we've allowed that currency exposure to tick up from 2, 3, and now up to 5%. And we think that's a good opportunity for the fund going forward. Despite the fact that investors are being offered very attractive rates on term deposits at the moment, we still believe that the Flexible Income Fund is an attractive opportunity because of its track record and its consistent ability to deliver 2 to 3% above cash, so higher than deposits. Now, we've been able to do that by moving quickly, by taking advantage of market opportunities when they arise. And the nature of a flexible income fund is that investor funds are available to clients when they need it. So it's very risky to lock your money away for 2 and 3 years. And when you need to make certain asset allocation or if you need to make allocation decisions based on changes in the market, you find that your money is tied up, and this can be quite a significant opportunity cost.